Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we're going to learn a topic which is known as operating cycle, one of the vital thing a company goes through because they always have to keep a track on their operating cycle. Without, if they are ignorant about that, or if they don't pay attention to the operating cycle, they may get into a disastrous situation if it is going beyond the hands or it is going beyond the stipulated number. Let's see Amazon and Toyota Motors cash conversion cycle, which is known as the operating cycle. If you see, the operating cycle of Toyota Motors is 96 days, whereas the operating cycle of Amazon is minus 18 days. That's a huge difference. It's like one is in the positive, one is negative. Let's understand this. See, what first we need to understand what is the operating cycle. This is the first and the foremost thing that we need to understand. The operating cycle or the cash cycle is of a company is an activity ratio. It is an activity ratio measuring the average period of time required for turning the company's inventories into cash. The process of producing basically or purchasing inventory, selling finished goods, receiving cash for the customers, and then using the cash to purchase produce inventories again is never ending cycle. So as long as company remains operational. So what we saw over here, cash cycle of Toyota Motors is 96 days, Amazon of 18 minus 18 days. Which company out of this two is doing better? So for the same, we need to look at one diagram. Now see the diagram over here, the raw material procurement. This is the operating cycle diagram. First, there is a raw material procurement. It is processed and it goes under work in progress. You come out with the finished good. You sell them. So you have receivables. Receivable means your debtors because you have sold them. The amount is yet to be received. And post facto, after a month or two, you get your cash. You use that cash again to procure the raw material. So this is the whole operating cycle. Over here, your creditors will be involved. Over here, your debtors are involved, and in between it's the inventory which is involved, from raw material to the finished goods. So this is your operating cycle. Basically, this cycle provides an insight on the operating efficiency of the company. Now this is useful in estimating the cash cycle, which comes in the middle in the working capital requirement for the maintaining the growth of the organization's operation. Now I'll say that shorter shorter cash cycle indicates that the company recovers its investments quicker and hence has less cash tied up in the working capital. However, if the operating cycle varies across industry, sometimes extending it to more than a year for some sector, for example, like shipbuilding companies, right? So let's understand the gross and the net operating cycle. See, the gross operating cycle is, which is also known as your GOC, this is also known as your GOC, is a time period after the raw material purchase, after the raw material is purchased till its transformation to cash. So as per the operating cycle formula, the time can be divided into inventory holding period and the receivables or the debtors collection period, right? Here, inventory holding period comprises of raw material holding period, work in progress process, and the finished goods holding period, and so on and so forth. Now, let's talk about the gross operating cycle. Its formula goes something like this: the inventory holding period plus you need to add any receivables or the debtors holding period, that is your gross, this is your gross operating cycle. So raw material, this inventory holding period includes your raw material holding period. Raw material, I'll just write in a abbreviated form: raw material holding period, work in progress holding period, and you have your final data, which is your receivable collection period. When we talk about the net operating cycle, It refers to the time period between paying of the inventory and the cash collected from the sale of the receivable. So it is also known as your cash conversion cycle, or it's also known as triple C. So the net operating cycle formula goes something like this: is equal to your gross operating cycle less whatever payments or the creditor's payment period that you do, right? So the net OC is considered a more logical approach since payables are viewed as the source of operating cash or operating cycle in working capital for the company. Now, let's do some operating cycle calculation. First, the days of the outstanding period. Days of outstanding period. This is the first calculation that we'll do. Now, the days of the outstanding period is basically the average number of days that is required for the company to convert its inventory into sales, right? A lower DIO speaks of the efficient use of the inventory since it signifies the lower holding period and little chance of the inventory become obsolete. So like automobile companies usually maintain just in time approach, the GIT approach, production system by maintaining minimum inventory levels and lower DIO. However, some companies may choose higher DIO to service customer order at a shorter time and thus maintain a competitive niche. So DIO is equal to 365 days divided by the inventory turnover. Right. This is the formula. Now the second is the days of sales outstanding. Days of sales outstanding. So the days of sales outstanding of the receivable collection period is the average number of days taken by the company to collect the cash from the credit sales. It gives an indication to the efficiency of the collection department and bargain power of the seller. While the lower DSO, it shows that increases the cash flow and liquidity. And a higher DSO may indicate less aggressive terms to boost sales, but could run the risk of the higher bad debts. The formula for DSO goes something like this. The DSO is equal to 365 days upon the receivable or the debtor's turnover. Okay. The next is third, which is the days payable outstanding. Now, the days payable outstanding or the creditor's payment is period is the average number of the days that is taken by the company to pay its invoices from trade creditors. So the DPO gives an indication of the efficiency in the cash flow management of the company, while longer payments period would leave the higher fee or free cash flow with the company. So the future credit terms may be less favorable for the company and discounts for the timely payments may not be available. So if the DPO of the company DPO, if this is lower than the industry benchmark, that would indicate the company is not using its cash in its efficiency as compared to its competitors. So the DPO formula is equal to 365 days divided by the payables turnover. And let's look at the cash conversion cycle of Apple. What we note that the cash cycle of the Apple over here is negative. Now, the Apple days inventory outstanding, which is 6 days, and Apple has streamlined the product portfolio and their efficient contract manufacturers deliver product quickly. The Apple's days sales outstanding is standing at the 50 days. Apple has a dense network of the retail stores where they get paid mostly by cash or credit cards. And Apple's days payable outstanding is standing at 101 days because of the big orders to the suppliers. Apple is able to negotiate better in terms of credit period. So if you just make the calculation, 50 plus 6 minus 101, which is minus 45 days, right? That is the negative cash cycle. I hope you have got a great insight regarding this topic.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.